Welcome to today's deep dive. If you were watching the KSC 100 ticker this morning on July 20th, your stomach probably just completely dropped.
Oh, absolutely. It was a brutal open.
Right. It didn't just open lower, it practically fell off a cliff. We bottomed out at a really terrifying intraday low of 173,636.45.
Yeah, sheer panic for the first few hours.
But then, if you logged off at lunch because you just couldn't bear to watch the bleeding, you actually missed one of the most aggressive, physics-defying snapbacks we've seen all year.
Truly. It was wild to watch it unfold.
Because by the afternoon, the index had ripped all the way back up to 176,129.35. And it eventually closed slightly in the green, right at 175,927.73.
Right, which is up 124.95 points, or about 0.07%.
Exactly. A 124-point positive close on a day that literally started with absolute terror. So today, for our mission on this deep dive, we aren't just looking at what happened on the surface. We're looking under the hood at the real market drivers.
We have to, because if you want to understand why the market is moving, not just what it did, you have to decode the momentum.
For sure. We're going to pull apart the specific sector trends, analyze the 4-hour charts, and decode why this completely volatile recovery actually materialized. Especially for you new traders tuning in, this is going to be a bit of a masterclass.
Yeah, because the difference between a retail trader who gets shaken out during a morning plunge and a seasoned trader who capitalizes on it, well, it comes down to understanding those underlying mechanics.
Right, because looking at an intraday chart today, it was honestly like watching a bungee jump.
That is exactly what it looked like.
You have this terrifying morning plunge and then this incredibly resilient snapback in the afternoon. But I have to ask, is this snapback a true structural recovery, or is it just a temporary bounce before the cord snaps?
Well, to answer that, we really can't just look at today's daily number. A daily close of up 124 points sounds peaceful on paper. It completely masks the violence of that intraday drop.
It really does. So where do we look?
We have to throw out the daily chart entirely. We need to look through the lens of the 4-hour charts to see the true momentum at play.
Okay, so we're zooming into the 4-hour chart, which ironically means we're zooming out a little bit from today's minute-by-minute chaos, right?
Exactly.
Because to understand today's specific bungee jump, we need to look at the cliff the market just jumped off over the past few weeks. The macro picture here is severe.
Very severe.
The KSE 100 was sitting way up around the 188,000 level not too long ago, and we've just been cascading down in this highly volatile descent straight into the 173,000 to 176,000 range.
And that descent from 188,000 is the context driving every single trade right now. Institutional capital is acutely aware of that macro downtrend.
Right.
Which is exactly why the 4-hour chart is the definitive tool for navigating this environment, especially for new traders.
Why specifically the 4-hour, though?
Well, when you look at a 1-minute or a 5-minute chart, every minor sell-off triggers an algorithmic reaction. It's pure noise. It's just fueled by immediate panic.
So it's too fast.
Way too fast. But if you rely on a daily chart, you're operating on a lag. By the time a daily candle closes and actually confirms a trend reversal,
the move is over.
Right. The institutional money has already repositioned. The move happened, and now you are buying the top of their rally.
Oh, wow. Okay, I see.
So the 4-hour chart sits in this critical center. It strips out the emotional noise of the intraday panic, but it processes data fast enough to show you where the institutional capital is actually shifting in real time.
It's a bit like monitoring a severe storm.
How so?
Like looking at the 1-minute chart is like staring out your window. Every single lightning flash makes you jump, but you have absolutely no idea where the system is headed.
Right.
And looking at the daily average is like reading tomorrow's newspaper saying, it rained yesterday.
That's a perfect way to translate it.
So the 4-hour chart is the weather radar. It shows you the trajectory of the storm when the heaviest pressure hit, and crucially for today's session, when the clouds actually started to break to allow for that 124-point recovery.
Exactly. And the radar showed this storm moving in heavily from 188,000. And this morning, it showed us slamming into a massive pocket of high pressure.
But the index itself, the KSE 100 is just a weighted sum of its parts.
Right, it's just an aggregate.
So if we want to understand the downward pressure pushing us off that 188K cliff, we have to isolate the weak links, don't we?
We do. We have to look at the specific heavyweights dragging the broader index down into the mud.
Which brings us to the extreme volatility we're tracking right now in the autos and energy sectors. Let's start with energy, specifically Pakistan State Oil, PSO.
Yeah, let's look at PSO.
So right now it's trading at 346.20. And it spent the entire morning aggressively testing its critical support line at 341.
It was a very precarious morning for PSO.
And the technical ratings here are flashing a glaring strong sell across both moving averages and oscillators. The RSI, the relative strength index, is hovering low around 42.65.
Yeah.
For anyone tuning in who is newer to reading these momentum indicators, seeing strong sell across the board while the stock is sinking towards support, I mean, that's a massive red flag, isn't it?
Is the textbook definition of a bearish consensus.
Right.
To put that RSI number into perspective for new traders, the relative strength index operates on a scale from 0 to 100.
Okay.
It measures the speed and change of price movements. Generally, anything over 70 indicates a stock is overbought, meaning it's due for a pullback.
Makes sense.
And anything under 30 suggests it is oversold, meaning it might bounce.
But PSO is sitting at 42.
Exactly. PSO sitting at 42 means it is trapped in this dangerous middle ground. It's lost all its upward momentum, the sellers are firmly in control, but mathematically it hasn't even reached that oversold territory yet.
Wow. Okay, so it's dropping, but the computer's saying, hey, it's not even a bargain yet.
Right. There's still room for it to fall further before the algorithms actually consider it a statistical discount.
So the floor might be way lower than people think.
Much lower.
And then we have stocks that aren't just trending down, they're behaving completely erratically.
Yeah, the high volatility laggards.
Like in the auto sector. Gondor Automobiles, GAL, is a prime example today. It's trading around 578.01 right now. And looking at this historical chart, we are seeing sharp, massive spikes in price that are just almost immediately erased by sheer vertical drops.
It is incredibly choppy.
And the technicals are completely split. It has a buy rating on its moving averages, but a sell rating on its oscillators.
Which throws a lot of people off.
Right. Okay, wait. I have to push back on this on behalf of our listeners. If the moving average says buy, but the oscillator says sell, isn't that just a fancy way of saying the computer has absolutely no idea what to do? Like, it feels like the data is glitching out.
I love that you brought that up, because it does look like a glitch. That divergence is honestly one of the most confusing things a trader encounters when they first start reading technical tables.
It looks like a total contradiction.
It does, but it's actually telling a very precise mechanical story about how the stock is behaving. We just have to look at how these two indicators are calculated.
Okay, walk us through it.
So a moving average tracks the longer-term trend. It smooths out historical price data over a set period of days or weeks.
Got it.
Because GAL has had those massive, albeit very brief, upward spikes recently. Those high numbers get factored into the average. The mathematical formula gets pulled up, so the longer trend still looks positive to the computer, which spits out a buy signal.
Ah, okay. So the moving average is essentially looking in the rearview mirror saying, hey, we've covered a lot of vertical ground lately. The overarching trajectory is up.
Right, exactly. But the oscillators, like your RSI, they do not care about the long-term trend. They don't look in the rearview mirror.
What do they look at?
They are measuring immediate velocity. They look at the current price action and calculate the speed of the buyers versus the speed of the sellers right in this exact moment.
Okay.
So while the moving average says the historical trend is pointed up, the oscillator is measuring the current order flow and realizing the buyers are exhausted. There is no active capital stepping in to push the price higher today.
It's like the moving average is a compass saying we are heading north, but the oscillator is the fuel gauge saying, yeah, but we are running on empty.
That is a phenomenal analogy, yes. And GAL is the ultimate cautionary tale of trying to drive on an empty tank.
Because it's so volatile.
Right. A new trader might filter a stock screener for buy signals, see GAL's moving average, totally ignore the oscillator, and just buy in at 578.
And then what happens?
Then they suddenly find themselves caught in one of those sheer vertical drops because the immediate momentum was actually dead. The institutional buyers had already stepped back.
Ouch. So if the fuel gauge is empty on these volatile laggards in autos and energy, where is the market actually finding the capital to pull off a 124-point intraday recovery?
We have to look away from the noise and look at the anchors.
Right, because there are stocks right now providing massive structural support, and they seem to be largely hiding in predictable trading channels across tires, tech, and cement.
Exactly. When institutional capital rotates out of a volatile sector like energy, it doesn't just evaporate. It seeks safety and predictability. And right now, predictability means unbroken upward channels.
Okay, let's look at the data on these anchors. Gontara Tire, GTYR, is trading near 33.48, Its RSI is at a very healthy 60.29. It has a consensus buy to strong buy rating.
It's looking great.
And when you look at its 4-hour chart, it is trading in this relentless, perfectly defined upward channel. And we're seeing the exact same structural behavior in tech, right?
We are. PAC Telecom, PTC, is trading around 69.80, and it is sitting in an identical, clear upward channel. Very measured, very steady.
Which is exactly what you want when everything else is chaotic.
Precisely. And to circle back to the RSI mechanics, G2IR sitting at 60 is the textbook definition of healthy momentum.
Because it's above 50.
Right, it's well above the midpoint of 50, meaning the buyers are firmly in control, driving the price off the channel. But because it is only at 60, it hasn't triggered that 70-plus overbought threshold yet.
So it's got room to run.
Exactly. It tells the broader market that there is still plenty of runway left for this stock to climb before it becomes technically exhausted.
And then we have the real heavyweights of the index. Cement and textiles. They weren't necessarily printing massive upward green candles today, but they did something that fundamentally saved the broader market.
They fiercely defended their support lines.
Yeah, let's look at the numbers. Lucky Cement, LUCK, is currently trading at 446.80, and during that morning plunge, it bounced perfectly off its long-term support line near 438.
A perfect bounce.
Maple Leaf Cement, MLCF, is holding its channel at 96.30. And in textiles, Interloop, ILP, is resting right on its 99.59 support line, currently trading at 100.44.
That synchronized defensive support across multiple heavyweights, that is the core architectural story of today's 124-point recovery.
Okay, let's break down the mechanics of a trading channel and support lines for a second. Because for you new traders listening, trading in a channel is a bit like bowling with the bumpers up.
I like that.
Right, like the top line, the resistance, and the bottom line, the support. As long as the stock bounces between the top and bottom lines, like MLCF and G2IR are doing, you know the game.
Right, it's predictable.
But what happens if it breaks the bumper?
If the bumper breaks, the technical structure of the stock is invalidated. It goes into price discovery mode, which usually means free falling into the gutter until it finds a completely new, significantly lower floor.
And the fear of that gutter is exactly what triggered today's massive buying volume.
Right. Exactly. But those bumpers aren't just invisible lines drawn on a chart by analysts. They represent actual physical market mechanics. They are massive walls of capital.
Okay, walk us through how that capital is actually positioned. When LUCK hits 438, what is physically happening in the order book?
Well, institutional buyers, algorithmic trading bots, large retail syndicates, they all look at historical price data.
Okay.
They see that in the past, whenever Lucky Cement dropped to 438, it was considered deeply undervalued and buyers stepped in.
Right, so it has a track record.
Right. And because they expect that behavior to repeat, they place massive amounts of automated limit buy orders precisely at that 438 level.
So they just leave the orders there.
Yes. They essentially park millions of rupees right on that line just waiting.
Oh.
So this morning, as the broader KSE 100 was free-falling and dragging every individual stock down with it, LUCK slammed into that 438 level.
MLCF hit its floor.
Right. ILP dropped to 99.59.
They all hit their respective bottom bumpers at the exact same moment.
And when they did, they triggered those massive resting pools of limit orders.
Wow.
Suddenly, an overwhelming surge of institutional buying volume executed simultaneously across cement, textiles, and tech. It absorbed all the selling pressure from the morning panic.
That is wild.
And that collective wave of buying at structural support levels is what physically arrested the fall of the broader index and mechanically lifted it back to 175,927. The bumpers held because the capital was there to defend them.
So the KSE 100 didn't just magically bounce. The individual heavyweights hit their respective liquidity pools, and the buyers actually showed up to defend the territory.
Exactly.
So synthesizing all of this, the downward drag of PSO testing 341, the dead momentum in GAL, and the structural defense of LUCK and MLCF.
Yeah.
How do we map out the coming week?
It's all about finding the high probability setups.
Right. If I am sitting down this weekend looking at my screens and planning my entries for Monday, where's the highest probability trade?
Well, if we pull up the broader technical top picks table for the week ahead, the data is pointing heavily toward real estate and technology acting as potential safe havens.
Okay, what are we seeing there?
TPL Properties, TPLP, and TPL Corp, TPL, are both flashing strong buy signals. TPL in particular is exhibiting incredibly consistent range-bound behavior.
Oh, really?
Yeah, it is bouncing cleanly in a horizontal channel with a rigid support at 15.08 and resistance at 18.24.
Okay, but here's the ultimate strategic question, though. Ask the so what for the listener. If I'm a new trader looking at next week and I see the broader market recovering, do I try to be a hero? Like, do I look at a strong sell like PSO, see it heavily discounted near its 341 support, and try to buy the dip for a massive reversal? Or do I stick to stocks like GTYR and TPL that are already demonstrating structural strength?
In a macro environment where the KSE 100 has just fallen from 188K to 176K, the overall market psychology is inherently fragile.
Right.
And during a fragile market, the absolute worst thing you can do is try to catch a falling knife.
It's just too risky.
Way too risky. Just because a stock like PSO is fundamentally cheaper today than it was a month ago does not mean the selling pressure is exhausted.
Right, the RSI told us that.
Exactly. An asset in a downtrend will often slice right through historical support levels because the institutional money is actively liquidating its positions. You do not want to step in front of that train.
Yeah, catching a falling knife usually just means you are the one providing exit liquidity for the institutions.
That is exactly how the wealth transfer happens.
So what's the play?
The pattern to watch next week is whether the KSE 100 can sustain this 176K level without retesting today's lows. Until the macro trend stabilizes, you want to put your capital into stocks that are actively proving they can weather the broader market volatility.
So the channels.
Yes. You look for established, unbroken upward channels like PTC and GTYR, or range-bound consistency like TPL, but you have to verify that the channel is real.
How do you do that?
You do that by looking at volume.
Okay, let's break down that volume verification because that really is the missing link between a stock just pausing its drop versus actually recovering.
Right, because price action alone can be deceptive.
How so?
Let's use TPL as an example. If TPL drops to its 15.08 support on Monday and it bounces slightly, you cannot just blindly assume the channel is holding.
Even if it turns green.
Even if it turns green.
Yeah.
You have to look at the volume bar at the bottom of the chart. If the bounce happened on very low volume, it means there was no serious capital stepping in to defend the price.
It was just a temporary lack of sellers.
Exactly. That makes it a weak bumper. It's highly susceptible to breaking if the broader market dips again.
Right.
But if it bounces off 15.08 on massive above-average volume, that tells you institutional money actively stepped in and absorbed the selling pressure.
I see.
High volume validates the support line. It proves the capital is there, making it a much higher probability trade.
It proves the bumper is made of steel, not glass.
Perfectly said.
So, wrapping up the map of today's deep dive, we zoomed out the 4-hour KSE 100 chart to understand that today's 124-point recovery is just one piece of a much larger volatile descent from 188K.
Right.
We decoded the mechanics of technical indicators, seeing how moving averages show us the historical trend, while oscillators like the RSI show us the real-time velocity, which completely explains the fractured signals in volatile stocks like GAL.
The fuel gauge versus the rearview mirror.
Exactly. And we saw how the market was physically saved today, not by magic, but by massive pools of institutional capital sitting at the support lines or bumpers of channeled heavyweights like Lucky Cement and Gondora Tire, absorbing the morning panic and lifting the index.
And honestly, understanding the mechanics of how and why capital moves is the only way to transition from reacting to the market to anticipating it.
Absolutely. The ultimate takeaway for your strategy this week is to stop trying to guess the daily close based on surface-level ticker numbers.
Yeah.
You have to look under the hood at the 4-hour momentum, identify the tug-of-war between weak lagging sectors and strong channeled sectors, and use volume to confirm whether a support line is actually being defended by real capital.
Definitely. And as you run your own technical analysis over the weekend, looking for those healthy RSI levels and unbroken channels, I actually want to leave you with a final thought on market psychology to ponder.
Oh, lay it on us.
We spent a lot of time analyzing how institutional limit orders create these rigid support lines, like Lucky Cement perfectly bouncing off 438. But it begs a philosophical question about the nature of technical analysis itself.
Okay, I'm listening.
Do these specific support lines actually hold? Because they represent the true underlying fundamental value of the company's balance sheet.
Like what the company is actually worth.
Right. Or do they hold simply because thousands of retail traders, institutional analysts, and algorithmic bots are all staring at the exact same technical chart, looking at the exact same line, and deciding to buy at the exact same moment?
Wow.
Making the entire concept of technical support a massive, synchronized, self-fulfilling prophecy.
That is a phenomenal question. Are we discovering the natural floor of market, or are we just collectively agreeing to stop digging at the exact same time because the chart told us to?
Something to chew on.
It really is. Keep the mechanics of that self-fulfilling prophecy in mind the next time you see a stock headed straight for the gutter. We will catch you on the next deep dive.